So let me teach you guys how you win at trading by trading this new level strategy. Now this video is for, this video can be used for beginners that's probably looking for a strategy to trade, something that you can easily understand and, a strategy that you can implement. Or this video could be for, intermediate to, people that's been trading for a very long time. If the strategies that you're using aren't working, or if if you're looking for a new strategy to add to your repertoire, this new level strategy could be really one that you can have in your bag, that really also helps you make a lot of consistent profits in the markets, right? But before I do that, let me go over what I have on the chart in terms of indicators, why I use them. I'm going to go over the indicators really quick and show you guys how I use these indicators to trade the Forex market. Okay, so this strategy is called New Level. This is my New Level strategy. It's from a daily time frame, meaning I take the signals from the daily time frame. I use a few indicators to trade this strategy, and it is very profitable to me. If you're part of my Facebook group, Forex King Facebook group, you can see the screenshots of the trades that I post. You can see how many pips that we are, that I rack up on a weekly basis in terms of just pips that I make and posting different trades. And we stay in the market, we stay collecting pips. So let's go over the strategy. First, I'll go over the indicators. Now I traditionally use Heikin-Ashi candles normally when I'm trading this strategy. I've taken the Heikin-Ashi candles off just to show you guys the strategy, simply because with traditional Japanese candles, you can see price action better than just the Heikin-Ashi candles. The Heikin-Ashi indicator, so those candles are pretty much made for following the trend, right? It is an indicator and it keeps you in the trades longer. But like I said, if you really want to see price action really well, then you probably come out better using Japanese candlesticks until you get used to looking at the charts where you can transition over to Heikin-Ashi candles. But that's neither here nor there, okay? So I'm using the Japanese candlesticks to show for this example. As you can also see, I got my 0.0 support and resistance indicator already plotted on the charts. So when you see the support and resistance on the daily time frame, know that you're looking at weekly support and resistance levels. When you see support and resistance on the 4-hour time frame, know that you're looking at daily support and resistance levels. Okay, so in addition to that, I have my 36 period moving average. Now this is a McGinley moving average, right? I like this moving average because it hugs price really close, and there's almost no lag in this moving average, right? So if you look at a traditional moving average, let me show you guys what I mean. If you're looking at a traditional moving average, so I take a 36 period moving average. Boom. Let's go here. Moving average. Boom. 36. Okay, exponential. That's good enough. Boom. All right. Ooh, it's about the same. But once this price goes to moving, once the price goes to, really moving on the chart, the McGinley moving average keeps up with price a little bit better. It hugs it a little bit more. So that's the moving average that I use, 36 period. Now down here, I have my 2 oscillators. This lower oscillator, this bottom oscillator is a traditional slow stochastic, settings 5, 3, and 2, right? Here, right here I have a modified TDI right here. So this is a TDI, Trader Dynamics Index Pro oscillator. I pretty much use the TDI to show me trend in overall price of the overall movement of the market, and then this trend right here, the short trade where it says short trade, shows me what price is actually doing at the moment. So this shows the overall trend. This shows me what type of trade I should be in, right? Short trade, as you can see, price is starting to come down right now on this time frame, right? So it's very accurate. Now the oscillator you see on here, this is an overlaid oscillator. This is actually my FX overbought oversold oscillator. Let me show you guys. FXR overbought oversold. The version is 3.3.21 oscillator. What I did, I just overlaid this oscillator over the TDI. Every aspect of the TDI, like the RSI, the market baseline, all of those things, I just changed the color to none so it doesn't show up at all. So I just use the TDI again for the overall trend of the market, and then I use it for to show me which direction price is moving, and then I don't use anything else from the TDI. Then I overlaid it with this oscillator right here to show me those are the oscillators that I like to use. And as you can see, the FX overbought oversold oscillator, FXR, and then the stochastic pretty much looks the same because it pretty much shows me the same thing. I've just been trading with the stochastic since day one, and I refuse to let it go. That's the story behind that. Nevertheless, so let me show you guys right now how you trade the new level strategy. Again, this is a really consistent strategy. It takes, you have to be a little patient. You have to wait on your proper setups, but when you do get a nice setup in the market, it pays well. Alrighty, it has a high hit rate also. You usually get 70-80% win rate on your trades. So let me go ahead and mark off. So what have I just marked off? So from line to line on the daily time frame represents 1 month of price data. So what I have just marked off is the month that we're going to be looking at. So let me thicken these lines up. All right. Okay. All right. Now I'm going to drop another vertical line on here so we can look at the trade we want. But I'm going to make that line. A completely different color. Let's go with red. Let's make this line red and make it. All right. So here's how you trade the new level strategy. Okay, so you always want to monitor which trend you're in. You're in a downtrend, right? On the daily time frame. So each candle represents 1 day of price data, right? This was the month right here of March, right? So how many trades could you have taken? Here's your first signal right here, right? So what makes this a signal? What makes this a signal right here? Price went up. Price started to reach. Price came down for February. When the month of March started, price began to retrace. Here's where your patience come in. Because you don't want to sell right here and get caught up in all of this drawdown. Yeah, you probably will make it out of the drawdown, but you don't want to sit through 1, 2, 3, 4, 5, 6, 7, 8, almost 9 days of drawdown. Not, your money's not working for you. You really don't know if you're going to win the trade. There's a possibility that price could spike on you, could lose the trade. So the one thing you don't want to do is sit through all of this drawdown. So this strategy calls for a lot of patience, right? So price retraced back into the level, to the, came into the moving average right here. Keep in mind, you only want to look for down trades because you got an overall downtrending market, which is not only confirmed on the daily time frame, but if I dip right over right here, if I go ahead and dip over right here on the weekly time frame, you can clearly see that this is a downtrend, and then you can also see it right here. All right, back to the daily. All right, so you wait for price to pull up right here to make his retracement move. Then you want to look at this candle right here, this engulfing candle. So what does this candle mean? Let me tell you guys what this candle means. Retail traders, we don't have enough money in the market to create this type of move down. This is called an engulfing candle. It's a big, thick candle. Shows a lot of price data, right? Right? So this is called an engulfing candle. Retail traders can't make this move. We make moves like this. This is institutional selling, right? This price came down. This is what moved this oscillator to the downside. This is what gave it this move, right? These oscillators, guys, the oscillators, they are showing you momentum in the market, right? Momentum moves before price does, right? Momentum moves before price does. So once you start seeing this momentum in the market right here, when the price started to turn down over the 80% line, you knew that, hey, this price is starting to get weaker. So let's look for a reversal. Not only that, it's coming into this moving average right here. This is a dynamic moving average. Meaning dynamic means it moves with price. That's all that dynamic means. It moves with the price, right? So once it comes into this oscillator right here, and then you see this red candle right here spikes down, which represents institutional selling, you know price was about to fall. So what you would do is you would go in and set a potential sell order right here. Well, you wouldn't put the order in yet. you would just probably just put a horizontal line right there. Then you would also put a stop loss at the swing high of this candle, because this is the swing high in the move right here, swing high. Or you can go ahead and stick it behind this level right here, right? This is probably where I would have put the stop loss at, behind this level right here. Then I go ahead and go down to my 4-hour time frame. Now I get the signal from the daily, but the trades are either taken on the 4-hour, or if I want to get a real tight stop loss, I'll go down to the 1 hour and take the trade. But let's look at the 4-hour. Okay, close that out. Let's find where we were. Here we go. I'm lethal with these charts, guys. I move pretty fast. Alrighty. So here's the entry. Here's the candle. Here's the close of the candle right here, but it's showing on the 4-hour time frame now. Here's where we got the signal right here when we put this line in. So what we want to do here, we want to bring our stop loss, try to get as close as possible without going over this line right here, this level right here. Or if you don't have this indicator, it would be the swing high right here, right? Right? And then now here comes the time for a decision, right? So you could enter the trade right here, but normally if you entered the trade right here, if you took your trade right here, a lot of times price will pull back first. So I don't know if you want to sit through that type of negative equity or this type of pullback, right? But as long as you use good money management, I don't see what the big deal is. Everyone deals with negative equity or price retracing on you or pulling back on you from time to time. So as long as you're using good money management, that's really not a big deal, right? So you could enter the trade right here, or you can wait till you get a pullback and enter the trade from up here, right? But you never really got a pullback on the 4-hour. So if you would have waited on the 4-hour, you probably would have never got triggered, or you would have probably came back and place an entry right here just so you can get into the position, right? Or let's take a look at we would have took this trade on the 1 hour. And guys, remember, the signal comes from the daily, but you can enter the market on the 4-hour or the 1 hour trade, on the 1 hour time frame. So let's find where we are. Boom. Where we at? There we go, right there. There we are, right there. There we go. Okay. So here we go right here. So look right here. Price came down right here. This is where we entry. This is where the close of the day was, where we entered the trade. How do we know it's the close? Because if I move this red candle, this red line right here, that's my date. My session begins right there. All right. So now we have a couple options that we can do right here. We can wait for price to pull back here, because it's different on the 1 hour time frame. We can wait for price to pull back to go in and take this trade, right? We could do that. That's an option. Or we could still just wait for the break of this level right here. Sell stop order. Wait till it breaks this level and take that trade for 126 pips, right? Again, the reason why these trades are so successful, because if you get a move on the daily time frame, if all day that pair has been selling off, take it back to the daily. Think about it. If this pair has been selling off, you got this move right here. This pair has been selling off all day, right? What's the odds of the follow through not being, this movement not following through? Very slim. Very slim. If it's been selling off all day, the odds of this price not following through and giving you a lot of pips is very slim. You're going to make some money off this pair, right? Now you're not going to win every trade, but you're going to win most trades. Put it like that. You're going to win most trades, right? So let's go back to the daily. The 1 hour. Look for our entry on the 1 hour. Look for our entry really quick. I'm going to show you guys something really quick. A couple options you have here. So what you can do, you can look for your entry either here. I believe I was wrong here, but even if, same thing, even if the entry's here, right? Stop loss goes back here. Boom. 147 pip stop. You hit that in 2.5 days. If you entered here, you hit it in 1 day, right? But okay. So I'm gonna give you guys a quick nugget, right quick, right? So let's say this is how I trade. This is why I rack up so many pips during the course of the week. So let's say my stop is 100, and let's say I entered the market from this right here, and my stop was 150 pips, right? So I know a 1-to-1 risk to reward. You can go back and look at my 1-to-1 risk to reward video to see what I'm talking about when I say 1-to-1. I know at a 1-to-1, I'm looking for 153 pips the other way, right? So I could automatically go in and put a line right here. Where is 153 pips? Let's say somewhere right here, right? So go ahead and drop a line somewhere in there. So my essential, my 1-to-1 take profit will be 150, somewhere in this range, right? So if I enter the trade here and I didn't make it, and so on the first day I made 71 pips, it pulled back on me, right? Once I get this pullback right here, what do? I take another position on another day. I'm stacking the positions now, right? Sidebar, that's how I make so many pips off one pair. I stack the positions. So instead of making 150 pips off a pair, I may finish the pair I may get 150 out of this trade. It pulled back. I may get another 140 out of this trade, right? And I may get another 80 pips out of this trade. So each pullback, until I get to this level that'll give me a 1-to-1 on the first position, I'm adding positions. As long as I'm in profit, I'm adding positions to my trades. I'm gonna do another video on how you add positions to trades. But and then as price is falling, I can go ahead and bring my stop loss down. So I'm lessening my risk on even the first position, right? Just some quick nuggets on how you trade the new level strategy, how you maximize the earning potential by trading this strategy. Just a real quick video I want to just put together for you guys. I hope you guys like it. Hope you guys understand where I'm coming from. If you have any questions or comments, feel free to leave those in the description of not in the description of the video, but in the comment section of the video. Also, if you want to reach out, email, join the Facebook group, all of that information will be in the description of this video. And you guys keep trading. Forex King, I'm out.